Good morning, everyone. This is Marshall Giller bringing you the morning comment for February 9th. Well, Friday's better than expected non-farm payrolls figures gave the dollar a huge boost. The upward revision to previous month's figures and the rise in average hourly earnings confirm that the labor market is strengthening. Investors are now firmly convinced that the Fed will begin normalizing rates this year. The monetary divergence should continue to push the dollar higher, in my view. The theme in the FX market nowadays is the indirect currency wars. Last week was the turn of the People's Bank of China and the Reserve Bank of Australia to ease policy and thus indirectly weaken their currencies. This week, the spotlight will be on the Riksbank monetary policy meeting and the Bank of England quarterly inflation report, both on Thursday. We expect that the improving economic fundamentals of Sweden could take the pressure off from the Riksbank to introduce additional measures, at least for the time being. Even just holding steady could be positive for the Swedish krona in the context of today's currency wars. As for the Bank of England, the November inflation report warned that inflation was expected to fall below 1%. This time, they might say that inflation could even turn negative. That could push rate expectations further out and weaken the pound. Oil prices continued to rise on Friday and this morning are up on Friday's opening levels. It appears that the sellers who took the price down from $60 a barrel to $40 a barrel were not oil traders, but rather were speculators. As they close out their positions, the price is coming back. It could recover further if they continue to trim their shorts. China's trade surplus hit a record in January, but it was bad news for the commodity currencies because the driving force behind the surge was a collapse in imports, not a rise in exports. The combination creates a dilemma for the authorities because a record surplus would usually mean upward pressure on the renminbi, yet falling exports argue for the opposite. The likely response will probably be more financial stimulus. On the other hand, if China continues to tolerate renminbi depreciation, that'll exacerbate the deflationary threat that other countries face and intensify the global currency war. Japan's current account surplus for December beat expectations as the trade deficit was narrower than expected. Like with China, falling oil prices contributed to the improvement. The current account surplus has been in surplus since last April on a seasonally adjusted basis. This may mean some stability for the yen for now. As for today, Germany's trade balance for December is coming out. The Swiss National Bank releases its weekly sight deposit data, which could reveal if the bank intervened in the FX market in the week ended February 6th. Sight deposits rose further last week, adding to signs that the central bank has intervened to weaken the Swiss franc since removing the currency's floor against the euro. Indications of further intervention could weaken the franc somewhat. The U.S. labor market conditions index for January will be released. This monthly index draws on a range of data to give a better sense of overall employment conditions in one single measure. A rise would add to signs of an improving labor market and probably push the dollar higher. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.